Very good afternoon and welcome to HYCM's Look Ahead webinar with myself, Giles Coughlin, Chief Currency Analyst here at HYCM. Hope everybody is doing well, had a good new year and a good break. Just looking forward to taking us through for the coming week. Hi Kingsley, Ricky, Vic, Warren, good to have you guys on board. Looking forward to just giving us a few heads up in what's coming in the coming week. Just as other folks are getting involved into the webinar, don't forget that we have just don't forget that as we're talking about different entries, exits, different trade scenarios, this is not trading advice. The whole idea of this webinar is that it is educational, that you learn to look over, as it were, the shoulders of someone who is trading from a professional background, and then you understand the thinking process behind the trades, and hopefully that will improve your performance going forward and help you with your trading decisions. Let's get stuck in and look at the calendar coming ahead for the week. But before we do, let's just check out the key market sentiment that we currently have going on. Now, if we go over to the market, what we see is that the market has started on a pretty firm risk on setting. Let's look at the equity markets. What we can see is that the equity markets, these are the futures markets, are pushing higher on the session. We are seeing positive sentiment. Also notice the positive sentiment we're seeing in the pound for the FTSE 100. Both the pound and the FTSE 100 is rising post that Brexit deal. We will cover that in a little bit of detail during the session. It's worth bearing attention to. In terms of today's sentiment, equity markets are higher. Commodity markets, they are higher too, being benefited by the weak dollar. So gold pushing higher, copper, Brent crude complex pushing up towards the highs of the day, just pulling off recent highs, but still well supported, generally speaking, on the day. Got OPEC meetings coming up at 2 o'clock GMT time, so that's a bit of a near-term risk for the oil complex. Silver, platinum also pushing higher, seeing some ETF flows increasing in gold as of late as well, which is helpful. Dollar weakness on the risk on tones has carried on. Dollar now, please note, falling into multi-year low region. This is a key support level for the dollar. And we just need to be aware of one phenomena, which is this. If you look at the dollar from a seasonal perspective, what you tend to see is this is the path of the dollar over the last 50 years. Towards the end of the year, the dollar tends to fall, and towards the start of the year, the dollar tends to gain. Why is that, you say? Well, the reason is quite simply because there are tax purposes for the dollar to leave US parent companies at the end of the year. It's a number of tax incentives to do that, and those dollars that leave the US end up coming back into the US at the start of the year. So just from a seasonal perspective, there is typically dollar strength at the start of the year. So that means with the dollar just falling into this key support level, don't be surprised if we see some profit taking from dollar shorts and a small pop higher over the next sort of 5 to 10 days. Be aware of that. It's definitely something to worth looking for. Now, I had dollar shorts. I was short the dollar into year end, and I've just closed those dollar shorts out because of the technicals and the fundamental reasons here. See, this is my trade, trading the dollar on the weekly chart, heading into middle of December. Very simply sold on the break of that Harami inside bar pattern and took profit down at those near-term support levels here, just around that sort of if you go back to the main chart, just into that 89.63 region. So I've taken profit because I'm expecting profit takers at this level. I'm also aware that seasonally speaking, you tend to see dollar strength coming into the start of the year. So that's one phenomena to be aware of. As long as the market's risk on, that should support a weak dollar. Now, this weak dollar narrative is set to stay medium term, and any retracements higher we'd expect to find sellers, but in the very short term it wouldn't be surprising to see a short snap higher. So that's one, key little area just to be looking out for as we come in to the week. And obviously the weak dollar has been supporting commodities high, gold really ripping up higher on that. And notice that gold has seen, let's just see if I've got that right. I'm just gonna pull that across. I'm going to show you the ETF flows. I just pulled this out earlier, so I want to give this. There we go. Now, these are the exchange traded fund flows. And do you notice that when we had that Pfizer-BioNTech vaccine news, there was a sharp sell-off in gold, if you remember. If you just look back at gold, you can see that very sharp sell-off around the 9th of November, one of the largest losses in the gold futures markets for 7 years. Huge selling off, right? Medium-term picture still pretty bullish for gold, so it was a buy on the dips. Now, looking at the ETF flows was a key tell. Now, you can see that the ETF flows, the exchange traded fund flows, they dropped around the same time. So one thing I was looking for before getting back into gold longs was I was wanting to see these ETF flows to start stabilizing. They want to see them keep going down because these ETF flows track gold prices very tightly and they tend to trend. You can see here it's trending nice and smooth. We now have ETF flows increasing again. So that drop off is now finding buyers. So that for me was an interesting tell that we can expect more gold side ahead. Now, if we get a break and close above this bar, then on a weak dollar, on large amounts of quantitative easing from the Federal Reserve, we would anticipate buyers back down into this level here, okay? So any buyers back down to that 1900 level could be suitable for longs. Now, looking at, this was the trade I took on gold on the FOMC, just to help, it's helpful to see how people trade. This was the FOMC meeting around the middle of December. And you can see that there were strong seasonals for gold coming up. In January and February tend to be very strong months for gold. If you just take a look at January and February here in the gold chart, you can see that, in the last sort of 25 years, gold has had very strong returns. It's only been a few years of losses, and they've been very minor, with some very strong years. And my second biggest trade last year was a gold long around December 2019 into 2020. And so I've just started this year as well with a nice strong gold long. I just closed that off today, early January, and I've got one clip remaining on the gold position. Now, it's not as big as a win as last year, but still it's a very healthy way to start the year with a nice solid profit, good 3-4% in the account from the very first start of the month. And I've also got a platinum position as well. This was on the FOMC trading decision, just to show how central banks can be traded. The fact that the Federal Reserve was pretty bearish, Jerome Powell assuring markets that the Federal Reserve would do whatever it takes basically to keep supporting US economies, and that was resulting in dollar weakness, and that was very supportive for gold longs. And so you can see that was the basis for going long gold, and now price breaking through that key trend line, which I was pointing out to traders beforehand. So we're now into that level, and then near-term support is here, 1950, 2000, and then 2060. So they're the next three levels up ahead. And of course, as we're aware, we're coming into very strong seasonal patterns. So you can see here, seasonal strongs, largest gain 14% January to February, largest loss 6.35%, that was in 2013. So seasonally, this is a strong pattern, strong time for gold. So retracements back down to that 1900 level could be considered suitable for long. And if we stay above this trend line, then that would be the signal to stay long. Get below this trend line and close longs. That would be a simple way of trading that. So that's a quick look at the market. That's where we're at. Looking at the strength of currencies, See broad risk on sentiment. Aussie, CAD, New Zealand dollar. It's a mixed picture, but broadly it's more strength than weakness. Got some strength in the Swiss franc, but weakness in the Japanese yen, weakness in the US dollar. So a slight mixed picture in the currencies. But the broad sentiment is that we have risk on sentiment. So we would favor Aussie US dollar buyers. So from an intraday perspective, any retracement back down to this sort of 0.7676 level can be considered suitable for longs. You can see here that's that key overhead resistance level from June 2018. We would favor buyers. Any retracement back down to there today, looking for a further move higher. So that's the state of play as we look at it. Let's now go into the calendar and see what we have coming up. So just pull this up for this week. Okay, so the first risk event to be aware of is the OPEC JMMC meetings. Now, the expectations for this meeting is that the production of 500,000 barrels per day is going to be returned to the market. So at the moment, the markets have reduced production. There are production cuts to support oil prices on the coronavirus supply issue. So basically, because coronavirus has been around, people haven't been traveling, haven't been flying, people haven't been moving, so oil has had less demand. So what OPEC have done is they've agreed to cut production to artificially boost prices. Now, since November, with the hopes of the vaccine, oil prices, have been rising because traders have been expecting oil prices to recover once again. Okay. Now, the key thing here is what the OPEC cartel decide to do today. Russia are quite happy to add more supply into the oil market. So they're quite happy to see a 500,000 barrel per day return into the market. Whereas Saudi Arabia, Kuwait, Algeria, they favor the production cuts carrying on. So expectations are that there will be a return to 500,000 barrels per day back in the market. So if that doesn't happen, we would expect that to support oil prices higher further. So that's just something to be aware of. We're seeing some volatility in oil today because of the OPEC meetings. They happened at 2 o'clock, so in an hour and 15 minutes. But remember, you can easily get delays with the OPEC plus meetings. But if you're trading oil today, just step aside because you've got these OPEC meetings coming up. You don't want to be getting involved with oil intraday before the meeting, and then look what happens at the meeting. If we have a scenario where production cuts are extended further, we would expect that to support oil going forward. So you'd expect that to be a buy on the dips after the event. But that's sort of event to be looking out for. 2 o'clock today, definitely a key one in terms of trading for the week. We have a couple of FOMC members speaking, but that's not going to be the main event for the US dollar. The main event is going to probably be the FOMC minutes and the non-farm payrolls data, but we'll come up to that later. Tuesday, another very quiet data front day. We have some CPI data out for France, some Spanish, German employment numbers, but nothing here that's expected to really be moving the market. Swiss CPI data, the Swiss CPI inflation has just been, in this very narrow range for years. Nothing expected to move the markets there. And the ISM manufacturing PMI data is probably the biggest event of tomorrow, but it's not really a market focus. What the market wants to see, it wants to see this PMI trend carrying up in expansionary territory. Wants to see manufacturing optimistic, wants to see purchase managers registering more orders, registering anticipation of a return to normality. So the expectation is 56.6. So anything above 57.5 or anything above 58 will be supportive for risk sentiment. So do keep an eye out on that heading into Tuesday. Not a great market mover by any means, not necessarily tradable, but just be aware of it and just see how the market responds to that ISM data coming out from the US on Tuesday. Wednesday, again, we have a series of PMI data from Europe, not market focus, so not a particular note. Bank of England's Governor Bailey speaking. Now, this will be more interesting. We'll just touch on Brexit now. Now, I was surprised by the reaction of the pound to Brexit. Now, what I was expecting a buy the rumor, sell the fact response in the pound, because I was expecting the pound to sell off after the Brexit deal was announced. And instead, we saw the pound carried on gaining post the Brexit announcement. So the UK and the EU have now arranged a Brexit deal, and you can see the pound is sort of merrily moving on higher as a result. So that positive move higher is investors who are coming off the sidelines and saying, well, now that the UK has agreed a trade deal with the EU, the pound, UK shares, FTSE 100, is more attractive. And that makes sense. So what will be interesting on Wednesday is what Governor Bailey says about the Bank of England's next sort of direction. Now, one thing to remember is that the Bank of England has been on the sidelines in the last few months waiting for Brexit. Now Brexit's happened, the Bank of England might more start to reveal their hand. So I would say watch out for volatility in the pound on that. And the particular aspect to look out for is, will the Bank of England be moving towards negative interest rates? If the Governor Bailey sort of really opens that way to negative interest rates, then look for some sort of sharp pound selling. The other thing we need to be looking out for the pound is the increase in coronavirus cases. Now, I just want to show you a little something here. If you look here, you can see that cases have been rising in the US but dropping in Europe. But you see how they've been sharply rising in the UK. So, you know, behind the US, it's the UK leading the way in COVID-19 cases. Now, part of the reason for that increase out in the UK is that a new variant has emerged in the United Kingdom that is more transmissible. It spreads more easily and more people are getting infected. And you can see that that's putting higher. And Boris Johnson has been out today saying new restrictions are coming for the UK. So the other thing in trading the pound generally, it's not just what's, you know, not only Bank of England Governor Bailey, but also watch out for rising cases and further restrictions on lockdowns. That could end up weighing on the pound heading into this week. So just to be aware of that. Keeping to be aware of the pound at the moment is being supported as the euro, as the Aussie, New Zealand by this weak dollar story. Dollar's very weak, but obviously heading into that key support level, as we've already touched upon here. So, you know, you got to hold that in balance. So it wouldn't be surprising to see some retracement lower in the pound this week. Not expected to be a big meeting, but definitely one to look out for. It's the FOMC meeting minutes. Now, last Federal Reserve decision, we saw the dollar selling off after the Federal Reserve. Now, the market will be looking at these minutes carefully to see, was there any dissent from Fed Powell's general bearishness? Did the board share the bearish outlook that Fed Powell communicated to the markets? Any indication that some members were more optimistic or weren't thinking of keeping interest rates as they are till 2023? We'll see some pound bullishness. So look out for how the minutes are interpreted on Wednesday. That could see some dollar action. Probably going to be a non-event, but definitely worth being aware of, you know, for sure, coming into that event. The other key event to be looking out for is on Tuesday. It just slipped my mind, and it's the Georgia Senate race decision. Now, at the moment, the Republicans control the Senate. But if the Democrats win the vote in Georgia, there is a possibility that the Democrats will control the US Senate. That will result in a stronger Biden mandate policy for the next term. So if we see this blue wave, if we see the Senate and the House both falling to the Democrats, then don't be surprised to see some more US dollar weakness. So we could see an acceleration in dollar weakness if we have a Democrat victory in the Senate. That's coming on Tuesday. So that got to bear that in mind. That's definitely a risk event for the US dollar, and something definitely one to be aware of. But it's not here on the calendar. So, but it's definitely coming Tuesday. It's the Senate race decision. Services PMI on Thursday, again, very low data point, but it'll be the services PMI that will be looked at carefully. Remember, the US is a consumer-driven economy. So what the US consumer is doing is very, very important, and services PMI will give a good indicator of how the US consumer is faring. That has the possibility to alter risk sentiment. Do look at that. Friday, we have non-farm payrolls. Now, the non-farm payrolls are expected to be a little bit of a non-event. You know, the expectations are for around a 245,000 gain in employment. That was the previous forecast. The expectations this time, so I correct myself, is 69,000. So we are expecting a slightly smaller gain in jobs, but still a gain nonetheless. Now, this isn't necessarily going to be a major data point, but the market does want to keep seeing this in positive territory. If we do get a drop in employment and we get a hike in unemployment rate, that's going to be very negative for risk sentiment. So do keep an eye on non-farm payroll coming into Friday. The general sentiment at the moment is that risk is on, a vaccine is coming, recovery will return in 2021. So that's the general consensus and the major picture going forward. Canada, employment change, 62.1 thousand expected, again tailing off, just similar to the US scenario, which is what you'd expect after the sharp rebounds we've seen post COVID-19 immediate recovery. And we're also seeing a little bit of a drop, 8.5% in the unemployment rate. That's good. The market wants to keep seeing that falling. Similarly with the US, 6.8%. Market wants to see the unemployment rate falling. The lower the unemployment rate, the better. You can see the levels 2020, you know, 4% unemployment. That's great. If you go back even further, see 2008. We saw those high levels of unemployment of, you know, 10%, huge levels of unemployment, slowly eked away. Unemployment rising rapidly to 15% at the height of the COVID-19 crisis on the back of the virus. But, you know, market wants to see that keep tailing down. If we see a jump higher, so a worst case scenario would be unemployment rate jumping higher to say like 8%, and then non-farm employment change, if we saw that dropping lower below zero, that would be a negative development, and that would be likely to change some of that risk environment. Remember the big picture at the moment, and the big picture is this: the market is recovering on expectations of a global recovery, right? But there are another uptick in COVID-19 cases, which will result in further shutdowns in the UK. Will this more transmissible variant infect the rest of the European Union? And how will the COVID-19 cases develop? Is this going to keep going up and up and up? Then it will hinder the UK's economy. Similarly with the US, if that keeps rising up and up and up, it'll hinder the US economy, more shutdowns. So the market's balancing those two narratives. The narrative that's winning at the moment is that there's going to be a recovery in risk sentiment. That's the big picture that's recovering. And I'll show you a trade that I'm in. It's on the Australian dollar Japanese yen pair. It's here. Now, if you look at this on a day-to-day chart, right, you can see here you've got a head and shoulders pattern. This is a trade I took going back a sort of 10th of December time. So you can see here that you have a shoulder pattern, head pattern, shoulder pattern. If you don't know this, go to the HYCM website and just look at it here. Put in head and shoulders pattern there. See blog.hycmlab.com. Go there and you can find out how to trade the head and shoulders pattern. But this is a left shoulder, right shoulder, head. Break of the neckline, you expect an extension of this pattern. So from 73 up to 77, so about 400 points. So looking for about 77 up to 81. So looking for a move higher up to 81 on the daily chart. Now, looking at this on the weekly perspective, you see that we have a huge head and shoulders pattern. Left shoulder, right shoulder, head. So looking here potentially from a medium-term perspective, there's a nice potential trade setting up, which is moving from March lows here, 59.78, up to 76.77. So that is, from roughly 60 to 77, it's about 1,700 points higher. So from 8 to 90. About 97. So you could look for a move higher, 1,700 points up to 97. So that is a potential longer term trade, held over weeks and months back up to that 97 region. So that's definitely one to keep on your radar. I am in this trade from a daily perspective. Okay, so from the daily chart, I've entered here. Got my stop running sort of 75, looking for a move first target up to 81. But ultimately, the ultimate target would be looking at a nice run up to that sort of 97 level. So that's one trade to be looking out for. And you can see this head and shoulders pattern. Do go to my blog. Look at the head, just go head and shoulders. You can search it here. And you'll see how to trade the head and shoulders pattern. I'll send you the link. I'll just put the link here. And you'll get that all there. Okay, folks, that is a few key things for you. Hope everybody's doing okay, and don't forget, back here on Wednesday for the daily, for the webinar outlook, where we choose a currency pair to trade for the day. Hope everybody's doing well. Hope everyone has a fantastic 2021, and look forward to seeing you back there. Thanks now. Goodbye.